Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, CSW, nor its affiliates, nor any of the respective officers. Personnel, representatives, agents, or independent contractors are in such capacity as licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and lists of standardized options. CSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, fantastic. How's everybody doing today? I'm doing very well because I had my oil trade. So we finally got to do it. I think we've been doing this since last week, right? We keep trying and trying and trying. I ended up making today $22,000, which is actually a small profit after a week of losses. So I'm very pleased, but it was an incredibly horrible way to make the money because it kept going against us. And where's the chart? Let me see if I can get the chart straight. I just posted it in the chat room, so hang on a second. It was horrible, though. It's not the worst way you could ever make a couple of $1,000 bucks. So 47.20 was the first time we shorted it, and it went right against us, though. And then it went to 48, and we tried again. Well, actually, I think we tried 47.50. But so it was a loss, and another loss at 48. 48.50, another loss. 49, another loss. And now, at this point, though, I actually had a lot of contracts. I think around here, I ended up with 10 contracts, and then we took another loss, and it got ugly for me. I went up to 20 over here. It went down, thank goodness, and I put a stop at 49.50. So by getting into 20, I think my average came up to something like 48 something, and but then getting 20 down gives you $10,000 when it moves down 50 cents. So that cut out a big portion of my losses. Then fortunately I went back down to like 10. Then it went against me, but you know what? I was frankly fine with that because it went against me, and I went back to 15. I didn't go back to 20. I wish I went back to 20, but I didn't. So I went back to 15 because it was coming into the nighttime. I didn't want to. I thought just in case I didn't want to be stuck at 51 with 20 contracts where I was like down $30,000-$40,000. So I stayed at 15 because I figured if it goes up here, then I don't mind adding more if I start in 15. If it was at 20 already, adding more would be real painful, especially if it kept going. Fortunately, it didn't, though, and it calmed down, and then finally, we got the drop we've been waiting for this whole time. And we're right back to where we started. So all this work, though, I've been stuck in this stupid trade for 1, 2, 3, 4, 5, 6. This has been a week of trading. And all this work was just to make a couple of $1,000 in the end. And at one point, I was down like $20,000+. So that was ugly. That was a very ugly way to trade oil. It would have been better if I hadn't traded with conviction early on. I mean, I didn't intentionally trade with conviction. The problem is that I'm working. I'm not trading for a living. I'm working for a living, teaching trading. But unfortunately, that means I can't sit there and stare at the screen all day and watch it. So when it runs up against me, if I'm in the middle of talking to people, I didn't see it until it was too late. And then I said, then I take what should have been a stop out and I turn it into a conviction. Because here, I was going to stop if it didn't fail 49, but then before I turn around and look, it's over 49.50. And at that point, I'm down $5,000. So I'm like, and since I do have conviction that I thought it was going to go down eventually, I would rather add. I felt better about adding than taking a loss. So that's where it is. I mean, $1,000 loss, I'll take it because I'll get it back in 10 seconds. But if I lose $5,000, it's annoying, and so I have to think about the best way to make it up. And to me, the best way to make it up was to double down, which, as I said, though, it kind of worked. So, I'm down 5,000 or so, or whatever. No, maybe more, because I think I had some other losses here. So I think I was down probably 10. This brought me back to just about even. I cut back to 10 from 20. Remember, I went to 20. Cut back to 10 at even. Thought I'd get the next leg down, but I didn't. Then it went back up, went back to 15, and now this leg is finally taking me back to a bit better than even. Now I'm out because my logic is 48.50 was bound to be bouncy. Where are we? Yeah, see, there's going to be some kind of bounce. And how much of a bounce? Well, from 50.50 to 48.50. Oh, it's $2. It's not $1. I'm being silly. This is a $2 fall. So we expect a 40-cent bounce. That's quite a lot. So on a $2 fall, you expect a weak bounce will be 20% of the drop. And yes, it isn't exactly $2, but actually the drop does work out to $2. It's a little bit below 50.50, and now it's a little bit below 44.50. 48.50. Sorry, I keep getting my numbers wrong. So technically, we're expecting a 40-cent bounce, and I guess if you look at it from here, from 40, we should come up to at least 80, and that would be a weak bounce. So a weak bounce is going to be way up here. If that fails, then they're in big trouble. If 48.80 is passed, though, then another 40 cents above that is going to take you up to like 50.25, 50.30 range. And where's that? Not 50, sorry. That, 49. So it's such a big move, I can't get my numbers right. So 48.80 is a weak bounce. 48.20, 49.20 would be a stronger bounce up here. And actually, you can see how 49.20 was a significant line over here. So this line here will be your strong bounce line. And you don't really want to see the strong bounce getting hit on the first day of bouncing. Certainly not in the first hour, certainly not quickly, because that's if you blow past the weak bounce already, you can say it's a strong move. And getting to the strong bounce is not a good sign that you're going to get rejected. It just means it's going to consolidate before it pops back over. What you want to see is a failure at the weak bounce if you're looking for it to go much lower. All right? But as you guys know, I like my fresh horses, so you got to look around and see what else you can trade aside from just playing with oil. I mean, that was what more do you want? You get a $2 down move. See now, I'm sorry. Back to this point though, it's a very important point. Had I been playing it properly with stops, we started shorting at 47.20. Stops out. Let's say you lose 100. Okay, so you lose 100 at 47.20. You lose 100 at 47.50. That's 200. You lose 100 at 48. You lose 100 at 48.50. Although actually you wouldn't have, because here you would have made some money. All right, so we got 100 back. So I'm sorry. So now we're down 300. Now it goes back over 48.50. You're waiting. It doesn't go back to his 48.50, but it quickly stops out. So let's call that another $100 loss. So we're at 400. Goes to 49. You try it again. You lose another 100, let's say. You try it again. You lose another 100. That's $600 down. It goes to 49.50. But it doesn't cross back under, so you don't lose any money. Now it goes to 50. With 5 down now, 500 down. Goes to 50 and you short it, and it doesn't stop you out. None of these would stop you out. Then you get down to 49.50. So there's your $500 back. Now you're even. So here you wouldn't have bet because it went over. Here you wouldn't have bet because it went over. It didn't come back and it didn't stop. But then here you get back in at 50. And it doesn't come back over, and it goes down and down and down, and it's $1,500 profit. So if you traded this with tight stops and did it properly, and I will go over what properly is. If you do it with tight stops and do it properly, you would have made $1,500 in the same amount of time I made $2,000, except I risked $20,000, and you would have risked $1,000 tops. So when you're learning for sure, tight stops are much, much better. And again, as I said, I did not intend to make this a conviction trade. It was simply the fact that I was busy and I didn't I didn't stop out when I should have. So let's talk about what a tight stop is. Or let's demonstrate what a tight stop is. So, all right, where would I want to bet? He's 2 up, he's 2 up, he's 1 up, he's below the line. So if the market's going higher, I would want to go long on the Russell or pop over this line. If the market's going higher, so I want to mark my position, 925, 475, 895. I'm going to look for all those numbers to break up. And if they break up, then I want to play the Russell at 25. So I'm looking for all 5, basically. So if the market's heading up, then that. Now, I want to see what the dollar's doing. The dollar's stuck at 93. Oil is at 48.64. Gold down. Natural gas down. Nikkei, who cares? It's too silly right now. Gold is way up. And coffee's still holding on. Coffee had a wonderful run since last week. Yeah, that was our trade from last week. Remember we talked about going long on coffee? It's a nice run. So now, on the other hand, who would I want to play if everybody's failing? If everybody's failing, the Dow is the highest above the line. So he's the one that I want to short. But the S&P has a better line. The 2475 is a good stop line. And the S&P is $50 a point. So I would lose $100 at 2475. I know exactly how much I'll lose if it goes against me. So I'm watching right now to see if I want to go short, I'm going to use the S&P, and if I want to go long, I'm going to use the Russell. And then I have no conviction right now because I want to do an example for you guys. Now as to oil, almost I would say if it fails this green line, but it's such a big move for a day for oil. I really don't want to bet that it's going to go lower than that. 3% down for one day is a lot. So we're not going to get any good indications, unfortunately. Hang on, let's check the news so I can get an idea of what I think the market will do. So as is now, I have no opinion of which way things should go. So let's just do a quick look at the news and see what it says. AstraZeneca downgraded. ETFs have a lot of money. FDA Celgene, Chinese Amazon. God, who cares? Honda sales. Oh, yes. Auto sales were not good. Let's take a look at that. Ooh, construction spending weak. Okay, now that's 2 things. Okay, so I think I told you guys this, but who knows who's new. I look at this like it's counting cards. Like I assign a negative point to things. So when I'm reading my news, I'm going to go like, oh, that's a -1. That's, things that count. So, most of these things don't count. That's a -1. That's definitely a -1. Nuclear revival, no care. Boeing contributes, we know that. Apple asks India for supplier tax breaks, who cares? Nissan sales down 3%, -2. So now, I'm sorry, that's -3 now. Refinery, energy transfer spectrum. Volkswagen -6. That's about that. See where I'm getting confused. -3, -4. That's 4 bad things. Thomson Reuters. Toyota has a gain. So let's take 1 away and call it 3 bad. Actually, you know what? I should take 2 away because Toyota's so much bigger than everybody else. So if they're up 4%, that wipes out a couple of people being down. Treasury prices higher after inline ISM. So ISM was okay. Treasury prices go higher because the Fed's more likely to raise rates. Okay. BP plus electric warrant on service station chargers. That's weird. How are they going to... makes no sense. Auto parts stocks decline. Automakers weak. Okay, obviously that's part of it. City advises on Micron. Junk bond buys ignore rules. Mazda's a minus. ISM was about flat. That's a 0. That doesn't get a positive or negative. Simon Property listed the retail sector. That's a +1. So now I'm going to take away one of my ones. So that's now we're down to just 1 minus. So not very negative. PMI was in line. That's a 0. Sprint 7%. Holy cow. Shell Europe will be shut. Whoa. Europe's largest refinery will be shut. Okay. So what's that going to do? That's going to cause a shortage of gasoline in Europe, but less demand for crude oil because there'll be less. So they'll draw down their gasoline stocks by 400,000 barrels a day. That's pretty significant. So over the course of a month, until mid-August, so over the course of 2 weeks, they're going to have 6 million barrels of unused oil. The refinery physically can't use the oil, and that's going to stock up the oil, but then they're going to have a drawdown of refined product. So we'll see what happens here. GM fall 15%. Holy crap! Now we're back to 2 negatives. So net 2 negatives. That's what I'm looking at when I'm doing this. And Ford also misses, so we're going to call that net 3 negatives because these are very important for America. And that's it. Everything else we knew up to the close. So basically, there's about three. Oh, fiat 10%. Holy crap! All right. So at least 3, maybe 4 negatives that we have here. So on the whole, and the more recent stuff has been negative, especially. So on the whole, we are going to look for the downside. I don't see any reason the market should be perking up. All right, but they are. So even though I don't see any good reason for this, and I'd love to short stuff, at the moment, since everybody's moving above their lines, we want to go long on the Russell. So let's. So despite what I just read in the news, let's take a long on the Russell. So why are we going long? Because we think that they're going to pop over the 25 line. And my premise is based on that I think that the Dow, the S&P, and let's get to the NASDAQ, take a look then, are all trending up. Although honestly not so much. I'm doing the close-up view. It's really not that big of a deal. But at the moment, I'm going to go one long on the Russell, and I'm going to see what happens here, especially now. The Dow is very sensitive. The S&P got rejected here, which is fine, and the NASDAQ got rejected here, which is fine, because you expect to get some sort of rejection when they're trying to cross a major line. So, don't be surprised if it doesn't blast through a resistance point. But if we're going to be bullish, then there should be there should only be really not much of a rejection, more like consolidation, which is kind of what the NASDAQ's doing here. Not really being rejected, it's kind of consolidating, trying to push above. The S&P also, you could say, is consolidating, because it's consolidating in between here, trying to get above that line. The Dow's already above that line, and the Russell is the furthest behind, so that's the one I chose to play long. So those are the markets we're going to watch, and we're going to see if we get a play. So like I said, with tight stuff, so I know that a full point, each tenth of a cent on the Russell is $5. So if I want to keep my loss at $50, that means here's where I would stop at $4.25. I would have to give up. So I'm willing to lose $50 if I'm wrong. That's basically the trade. Once it goes over, then that 25 line becomes my stop. And I lock in a gain of $50 at that point. And obviously, as a demo, I wouldn't be playing one contract if I was taking it seriously. And again, I don't have conviction for this play. I'm only just playing what I see. And what I see is the general trend is heading up on the other indexes. The Russell is the one that's moved the least up, and therefore I want to play it up. Now, since I'm in it long, I'm keeping an eye on the other indexes. If they all start turning red, and you can see they're turning red because they're all red. They're physically red. When the indicator moves up, it's green. When it moves down, it's red. So the last trade, see, this is neutral, and it's white. See, now it moves up, and it's green. See how that works? So you can quickly see what the last move was just by saying red box, white box, red box. So when they all go red, when all three are red, that means they all three move down, and I've got to be careful about my lone green that I have. And I don't want to see if they start ticking down again, I should just take this money off the table, even though it's only, what, $20. But the point is that conceptually, that's what you have to get used to doing, though. If you want to learn how to trade, you got to learn to take the very quick money off the table and be done. Just walk away. You know, especially when the thing is your premise is breaking down. My premise is breaking down because everybody's red. See, red, 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 and they're not changing. All right, again, these boxes, red, red, red. They haven't been green the whole time we've been talking about what color they are. See, and now he fell again. And that's to make a loss if it keeps going down. So I'm only going to give it one more tick and I'm out. So this is, people say, what do you mean by tight stop? This is what I mean by tight stop. Now he went white, but white only means he didn't fall. Doesn't mean so that's since the last transaction. In other words, it keeps track of the previous transaction versus the current transaction. So the most recent transaction was higher or lower than the last transaction, or the same. If it's the same, it's white. And if it's red, it's lower. And if it's green, it's higher. That's all there is to these. Now, that was a good pop. So that was encouraging. But again, we're the only ones that are green. Nobody else is green. We're doing this by ourselves. And why is that happening? Because the Russell, if the other guys aren't really falling down, then the Russell's going to start catching up. And I don't like that there's 14 sellers and only 5 buyers. Now it's 27 buyers, 14 sellers. That's good, but already dropped. These guys got eaten up very fast. 10 and 3, see? And it keeps changing. So there's some relentless selling going on there. So I'm out. I don't like the way I saw a lot of sellers and it kept filling up the buyers, right? So now I made $5. But, if that was the S&P, I would have made $50. So I'm saying, and if I, but again, you have to have conviction. And as I said, though, my reading of the news says everything should be going down, not up. So what do we say we wanted to short? If things are going down, we wanted to short the Dow, right? And unfortunately, he's already taken a powder. But if everything's breaking down, we said the S&P was the best one. See, now you see what I meant by that? Because it got rejected right at this line. When you see a line like that, you want to play that. That becomes your backstop. That's an easy place for you to know when to stop out. So when I say tight stop, that's what I mean. Find a place where you can say, I will definitely get out of here and take my loss and go home. And it's okay to lose $5, $10, $50, whatever, and then but you have to remember to make $5, $10, $50, and take it off the table. Because it's not about whether you win or lose the small money. It's about once in a while you'll catch a good one and you'll make $100, $200, $500. But you won't do that if you keep letting yourself lose large amounts of money when you're wrong. Once in a while you'll be right and you'll catch it at the right time and it'll go exactly the way you want it to go and it'll give you a good ride. Okay? Every other time, just get out. So you get instincts that went down. So once in a while, you'll catch it just right. And I would have caught it just right if I went in my head, which I should always go what I think. That's like when I get a gut thing. So like I said, I read the news. I didn't like the news. There was nothing positive. There was no reason for these guys to be bouncing. I felt better about being short than long. That's one of the other reasons I got out quickly here. I didn't really feel good about being long. I was only going long because that's the way everything was going. So now we got to watch it, and I'm not that enthusiastic about playing either way right now. But I think here now, the next point I'm looking at is 72.50, and below that line is a good spot where we might get a nice run down the S&P, and it's an easy stop. So that's a good place to do the next short. So if everybody keeps breaking down, 72.50 is the place I want to get short, with very tight stops above. Now these are 50 a point, so each quarter point is $12.50. So again, you're not going to lose much if you play by the rules, if you keep the tight stops. So I'd like to sell one at 272.50, but only as it's going down. I don't want to sell at 75 because that's 27.50 is holding. That's the opposite of what I want. I want to see it go a little bit below it. And I also want to see all the other guys being red while I do that. I don't want to do it when everybody else is turning green. But watch, it's a very important thing about these charts. White means the last trade went off at the same prices as the current trade. Red means the last trade went off at a lower price. So 272.75 is 472.75 is the last trade, and it was lower than the trade before it. Now it went to 73, so it's neutral. And he's neutral, and he's red, and he's red. Now we're back to there, and it's red. See, 75 is now lower, so it turned red. And now we're back to 73, which is neutral. And I don't know why that's considered neutral. Because to me it's up 1, but I guess they figure the same ballpark or something. I'm not sure what their rule is. You know, he went green. But I don't want to short if he's going green. I was hoping this guy go down. So unfortunately, we seem to be kind of stuck here, which is going to make it tedious to watch. Yeah, it's one of the problems with trading futures. You can't really do it on demand. You know, you gotta kind of find it when it happens. So I'm not liking the way this is going, because if this was weak, he should be curving down, no problem. And he's not. He's hanging out there. It's not as weak as I thought it should be. Still, going my gut, I still say short here, and I would short here with a stop at, let's say, 73.75, which is right here. So if it goes up to there, I'd short that with a tight stop above it. Got no problem with that. And, you know, and honestly, the difference between this 75 and that 75 is $50. So, you know, again, it's just a matter of, I want to show you the right way to trade. I often go into the trades anyway just to get the thing started, but the point I'm trying to teach you is the discipline of not doing that, of being very tight with your money, being very explicit with your stops. Because the most important thing in futures trading is not losing money. You will make money accidentally if you concentrate on not losing money. There's always a trade. You're always going to get a good leg if you have patience for it. All right, so you follow the rules. When it comes under, as it's moving under, that's when you short. Then you stay with it until it pops over or until you make a little bit of money. So down here, you would say, see here, you could say, this is so little money it wouldn't be worth taking. On the Dow, that's $50, right? So it's a $50 range, up, down, 50. But you can see that it's staying below your line, so that's a good sign. And it kind of drifts down, drifts down, drifts down. Now here, it starts you're at 93 or 925. You're forming a bit of a base, and then here is where you would probably stop out because it breaks above the previous range. And so if you stopped out here, you still make the same $50 you would have made if you took it in the first place over there. But then it goes back up, you get rejected, and now you can go back in because you see it got rejected off the line that you started at before. And then you get a nice, and this is what I mean about accidentally getting a nice move. So you made $50, you wait, now it gets rejected. Now you get a lovely move, like a $50 drop. That's $250 on that drop. And there's no reason here to stop out at all. Oh, there's my 250. So what's going on? He's green. I don't like him being green. And he's not that red, and he's flat. So I'd like to short it here, but I'm just not really seeing it. Now these guys are pretty evenly matched, 400, 362. So there's no overwhelming thing here for it to go up or down. And these guys are kind of evenly matched also. So there seems to be sort of like a stalemate here at this level. All right, so it's the same thing here. It's like now we have our 5% lines. I'm not talking about those now. I'm just talking about looking at these lines right here. When it goes over, if you're betting up, when it goes over is when you want to make your bet. So maybe you made a bet here and stopped out, but then you make another bet when it comes back across, and you have a huge run. And on this one, this is what, 69 to 73 is 4 points, and that's $200 for this run. Then it goes not really over, not really over. So none of these would be something you'd play, or if you play, it'd be a teeny tiny loss, a little bit over and back down, so probably nothing here either. But then look, you play it again, and boom, it's another $100-something run. But you've got to be happy with $100. But look at it though, you can make $100 over, you make $100 here, you make $200 here, $100 here, you make $50 here. If you get used to taking it, it adds up to like $500 that you're taking over the course of the time you're sitting down. But you've got to have the discipline to stop out of these things, and you've got to watch it like a hawk, and you cannot, again, unless you're playing with conviction, which I do, because I'm always reading the news, I'm always looking at stuff, I always have an opinion of which way things are going. I don't usually get into a trade unless I feel strongly about it one way or the other. So when I go in, I do have a conviction, and I do wish to stay in, and also I have a lot of money, so frankly, I don't mind if I'm down a few $1,000. But if you're starting out and you're worried about losing money, play tight. Always play tight. And even if you have a lot of money, learn how to play tight before you play loose. Because playing loose can kill you if you don't know what you're doing. I mean, that oil trade would have killed me if I didn't manage my money well on the way up. I mean, at a certain point, I would have just thrown my hands up. But I know how to get in and out quickly and turn and keep moving my bases higher, so that it made sense for me to stay in. One day we should do like a whole futures weekend where we all get together and like play the futures for like 2 straight days. We all sit there and that's all we do for 2 days and follow these trades, because that'd be the best way to learn, really. Actually, it might not be exciting, but I mean, if you drink a lot of beers and watch TV and do other stuff while we're doing it. How's that for a seminar? All right, let's see who's got questions. Twitter, RB, we have the beef. All right. Well, I mean, gasoline, I said this morning was shortable. I said that all the way up here. I think the contract rolled over if something happened over here. It was weird action. But meanwhile, it's the same as oil. It just was overdone. It pulled back. No biggie. I do like the dollar here, down here, but I'd rather play it after it crosses 93, so I have a stop. Again, I want to have a stopping line. Whenever I get into something, I want to have a line that says, you were wrong, get back out. I want to have a very clear line that tells me when to get in and out of things. That makes me feel so much better about getting to a trade if I know I've got a backstop. And so once we're over 93, that should be a good, if we're bullish, that should be a good backstop. If the dollar is really going to be moving up, then 93 is going to be a good backstop. If 93 isn't a good backstop, it's telling me I shouldn't be in the trade. It's saying I can't even hold 93. Why are you bullish on me if I can't even hold 93? Makes no sense. Twitter is not getting their act together. I know there is time, but maybe better places to deploy cash. I don't disagree necessarily, but let's see. You must be talking about the OOP, because frankly, in the long-term portfolio, there's no issue as to cash. In the OOP, what do we have? We have the 10-18 spread that expires in January. It's up $4,000, but the net is about $5,000, and we can make $3,000 more. So you say there's better ways to deploy the cash. If I leave it in this trade and Twitter hits 18 in January, in 6 months, 4 months, what is it? It's August, isn't it? So like 4 or 5 months from now, I will make 3/5, which is what, 60%. So how confident am I that I'm going to make 60% on Twitter? So how do I make 60%? It goes to 18. Let's take a look at Twitter. Twitter. All right, so, wow, that was nasty, huh? So it fell all the way back down here, and now it's consolidating on the little M line that it made. And it's at 16, and we need to get way back up there, though, in January. So we have to decide, is this pullback a pullback, temporary, or long-term? What's going to actually happen? And how confident am I? So I do have money at risk, right? We do have a risk, but we're we're in the 10s, but we'd like it to go. Oh, even 10. Oh, where is that thing? Yeah, we're in the 10s and we sold the 18s. Okay. So there. So this was nasty. And now let's take a look and see what happens. So they're down to $11 billion, and their earnings are not going to be current here, I don't think. They didn't make any money. That's a problem. Not last quarter. I don't think this quarter they made any money either. Sell Twitter stock turnaround isn't happening. Tesla, Twitter, fake McDonald's. Now, why Twitter tank despite topping estimates? Let's see if they know. They don't ever actually know this. This is just bullshit. This is robot news when we see these things. Company's revenues came in 5% lower than last year. Revenues came in at $575, beating expectations. Company's ad revenue beat earnings, pays 12 cents a share compared to 5 cents a share. Well, that's quite a beat. There was a loss with the one-time earnings compared to a loss. Twitter has now posted net losses every quarter. Early. Intel. What happened to Twitter? I'm like, why am I reading Intel over there? And they didn't add monthly users. That is a tough one, I got to tell you. Still, what did they make? The bottom line is they made 12 cents a share. So let's say they make 50 cents for the year. I mean, $16 is a lot on 50 cents. It's 32 times earnings. So it's not cheap. I don't want to say that. But I do think they're on the right path for long-term play. And I do think that if the market keeps going up, then Twitter's going to hold or go higher. I don't think, if it breaks below the 16 line, I might want to rethink it, but I think the 16 line is going to hold. And if the 16 line holds, then we're certainly consolidating to move back into this range. So, I don't have a glaringly better way to make 50%, and we don't need the money, and I think that if we give Twitter longer time, it'll go up anyway. So even if they do go a bit lower, I might just want to roll out to 2019, let the short ones expire, sell some more, turn into a longer-term trade. Again, at the moment we're up $4,000. If we're only up $3,000, maybe I'll pull the plug and wait for a better time. But right now, I think we've got we have more of a chance of using the $5,000 that we have. I think we've got more of a chance of making 3 than losing 1. So I'd like to see that play out, since I have a huge advantage if I'm right on the upside. All right, so that's the thought process I go through when I decide whether I want to keep something or not. Because you're very flippant with your surely we have easier ways to make money. I'm like, I don't know, it's 60% in 5 months. I don't really have that many ways to make 60% in 5 months. Red and green lines of the pivot point set. Yes, they are. That's called pivot point set. Window dressing is still in play. No, it isn't. Technically, it's not. And I thought that the futures pump up with window dressing. I mean, that's a continuation. Because what happens? Window dressing means the funds are trying to prop up the market ahead of their, ahead of the close of the month, so that they have nice monthly books. That's what they want to look like. They want to show all their stock look good, so they do what they can to shove everything as high as they possibly can. Now, that being the case, they didn't really want the stock. Like you're buying, like if you own Tesla and you want the month to close well, you're going to buy up Tesla into the close of the month. Then the next day, though, you don't want it. You didn't really want to buy more Tesla. You just wanted to make the market think you did. So they generally want to start selling like the next day. Not necessarily all at once, or if the market looks good and things look strong, they might not do it. But one trick they use is they'll pump up the pre-market, which you can do on practically no volume, and they'll pump up the pre-market, get a nice big move, hopefully bring some retail people in, and then they can sell off all the crap they bought for a good price. But it's not an abrupt thing because it takes them days to unwind the positions that they got into last week. So we'll see. But what we're looking for is signs of selling pressure, and we already have it because look at the hang on, I'm looking at the computer. It doesn't help you guys. The Russell is red already. The NASDAQ is barely up. The S&P is barely up. And the Dow's up, but the Dow is stupid. We know the Dow is stupid. Oh, and meanwhile, everyone's trending down, so that means that now's the time to short the S&P. Hang on. Because everybody's trending down nicely. So now I want to go with my short. So, we're making that downside progress I was looking for, and so I'm hoping the S&P breaks below this line, at which point I'll turn it into a stop line. I really want to see the Dow curve under this thing, though. I don't like the way the Dow's going, but the Russell is certainly turning down nicely. The NASDAQ seems to be turning down nicely. So I'm betting the S&P will be next. That's what this bet is. And basically, if we go over 473, I should stop out. And that's my risk, is going to 473, I stop out, I lose $50, right? Or $25, right? It's $25. But now what's my reward? My reward is getting to 70, and I'm going to make $125. So I'm looking to make $125 on a move down versus a risk of $50 if it goes against me. That doesn't make any sense. Risk of $25. I'm thinking of it more than it is. So I'm risking 25 to hopefully make 125. That's where I'm at with this trade. And that's how you always have to think of your entries. What am I risking and what am I going to make? And if I'm always going to make 5 times more than I'm risking, if the trade works out. But if the trade works out like I think, I'll make 5 times more than risking. That means I can be wrong 5 times and right once and still end up okay. But that only works if you stick to your discipline. If I start off saying that and then let it go for $200, then I've blown it because now I have to be right on like 2 really good trades just to get even. So it's all about having that stopping discipline. And also, though, now, you have to be aware of how much an index moves. So in other words, this thing's fluctuating up and down from 75 to 50. That's perfectly normal. So I have to give it at least 2 spots. Otherwise, otherwise I may as well just get handling the 12.50 with a loop. So I have to know how much the S&P will usually move if it's heading down. So in other words, I know to go up and down 25, that means nothing. But once it goes over the 00, then I know I'm in trouble. As long as it's under the 00, I'm not in trouble. So I have to wait and see what happens. So now I'm watching everybody to confirm that we're on the right track. He's still red. He's green, don't like that. And he's green, don't like that. Now I'm down 12.50, see? And now I'm back to 0. That's all you can do is just watch and wait and see what happens. Oh, that's a nice flip. There we go. Up 1250. Woo-hoo. But I'm waiting for a better move. And as long as we're still trending down on TF, we're good, right? As long as the Russell's still going down, and I'm hoping if one of these guys breaks down, that'll confirm for me that we're on the right track. But so far, they're not doing that. And holy crap, this is such slow trading. I can't even believe it. These guys are barely doing anything. Now, I like this. See, 17 to 1, 8 to 2, 22, 25, that's no good. 16, 10, no good. So only the Russell is really in our favor. And here's a big buyer, 21 to 2. 20 to 2. Oh, 21, 22. There's a seller who came back in. So there's a big seller, but he's keeping his cards close to the vest. In other words, he doesn't show all of his selling, but every time they try to get in on the buy side, this guy comes in with more sell. See? Every time there's another big. He keeps throwing chunks of like 20s at each price level to see if he can get rid of them. Look, see that? And he's going to throw another 20 in probably. Nope, we got rid of him. Nope. See, 20. This guy keeps punching the button. So in other words, when you set these sells, I can set it. I have mine set to 1 usually, but you can set them to 10, 20, whatever. So there's some guy who seems to keep throwing 20s at the sell side. He's obviously got a decent amount to get rid of. But once he's gone, then it's a problem. Then maybe the buyers take over. You have to be careful. So you want to make sure you see these numbers in the 20s, because these are only 2. So once you see these numbers stop being in the 20s, that means your big seller's gone, and that means the thing might reverse. See 4, up, 12, 7, not good. 19 is not 20, so that means the big guy did not throw his 20 in. 7, 4, see what I mean? The guy who was throwing 20s to the sell side left. So that's a little iffy for my trade here. I might want to get out of this. So what am I short? I'm short. So now I'm keeping a very close eye on it. There is still a seller on the Russell. No, 29. That's good. 5, though. See? That's not the same guy. 28 here. 12. It's not being replaced. 11. No, I'm thinking that's not going to work. So let's see. If I want to get out of this, I try to buy it back at the same price I sold it for, which would be $72.50. I can sneak in with all these guys. 700 sellers here. It's a lot of sellers. It's pretty big imbalance. But he's going back up, and he's going up, and he's flat, so I should be getting out. Not working. Now I'm one of these 254 buyers, and I'm hoping to buy at this price. But it's not looking good here. Now this stays flat, but this keeps going up. So basically, this trade isn't working for me. I'm getting out. That's all. Didn't do what I thought it would do, so I want to get out. And I say you've got to play. You have to have that kind of discipline. I'm going to lose 1250, so I'm going to have to buy it back over here. Oh, no, it's still. All right. See, patience is good, too. So I ended up with no profit, no loss, and, of course, it cost me about $1 each way to go in and out of the trade. So I lost $2. That's okay. And now we move on with our day. That's most of your futures trading should be like that. It should be like, okay, zero, didn't work, out, done. Now let's try again. Wait for the next setup, try it again. If you have a discipline, you get to try dozens of times a day and without losing any money, and then once in a while you win and go, oh, great. And before you know it, by the end of the day, you've got like $1,000 in your pocket. But that only works if you don't lose money when you're testing. You can't lose a lot of money testing the waters. That's no good. Wait, we're not getting through too many questions, are we? All right, a couple of questions. How do you qualify what you count as news? Plus or minus. That, unfortunately, is more art than science. Hang on a second. Let me get some on here. All right, there you go. See, now it's falling in. Oh well. But look, I look at news stories, and in my head, I'm not really like physically counting it, because I mean, I'm just trying to explain to you guys what's going on in my head. But in my head, I'm looking at something, and I would say more so than a number, I'd say there's probably like a little ball, like in the middle of a graph, and it's like a good and bad side graph, and I sort of think of it like moving more one way, tilting one way versus the other way as far as whether market news is positive or negative. So I think about the total impact of the news on the market. So there's tons of news. So let's just look at a couple of articles real quick. VanEck, who cares? Enrollment, I also read really fast. So it's, Silica Sinks. See, we talked about that. I told you guys I was worried about that. All right, Subaru Plus. The Subaru is a little tiny car company, so I don't care. I note it, but it's, I'm like saying, oh, Subaru sold. Sold 55,000 cars. Who the hell cares what they did? Vanguard, and don't forget, 7% of 55,000 cars. They sold 5,000 more cars. That's basically what that says. Okay, so Apple is always a thing. So Apple has wireless charging. Who cares? Fitch downgrades AstraZeneca, not very important. ETFs hold more money than hedge funds. Who cares? I mean, I care, but it's not for any reason it's going to affect the market today. Or more, not today. In my time frame, you have to also think about in my time frame for what I'm trading. What's the news? So, I like seeking out the market because first of all, a lot of people read it. Second of all, it's pretty well curated. So if you look at this, you get generally what is the news that's going out. The people are reading in the market right now. This is what people are reading. So, all right. So more hydraulic fracturing, negative for oil, right? So in my head, that's a minus for oil. Minus for oil is also minus for the S&P. Okay, and minus for the Dow. You have to think in terms like so. See, there's a lot of thinking involved. I'm thinking that. I'm thinking of S&P. So oil is 15% of the. It's not even. Oil is like 12% of the S&P right now. So it's a negative to 12% of the S&P. It's a negative to 2 of the major Dow components. And if you want to go further than that, I know it's Exxon and Chevron. I know Exxon and Chevron are both around $100. I know that Exxon and Chevron both go down 2 points, which is 2%, which would be a lot for a day. That would be 4 points for the Dow times 8 is 32. So in a negative like this could affect the Dow by 16, so them losing 1 point each, 16 to 32 Dow points. This story is good for knocking down. And in the S&P sector-wise, it probably is about the same percentage. Because there's a whole sector there that it would affect. So so in my mind, I'm following through all these like dominoes start falling as far as like how something's going to be affected. Honda sales 1%. Now that's 1% of Honda is a lot more than 7% of Subaru. 1% of Honda is 15,000 less cars. So now I'm seeing a bigger negative on Honda that counts. All right, it's still not one of the American companies. Pfizer needs to do something that's fine. Who cares? In fact, we were talking about getting some Pfizer today. I wanted them to be negative because we want to get back into them. Construction spending is a huge negative. Okay, it's down 1.3%. Shouldn't be down in the summer. This is when it's supposed to go up, not down. So it carries more weight because I understand the seasonality of construction spending. It's much worse than the headline says. It's not just a little decline. It went down 1.3% when it's supposed to go up. And even says plus 0.4% expected, but that's a lame expectation. But that's a miss. This is a miss of 3 times what it was expected to go up. That's terrible. All right, nuclear revival. Now, I read that article, I go immediately, well, that's bad for CCJ. All right, but it's good for coal, it's good for natural gas, because you're taking a nuclear project off the grid. All right, Boeing puts money in their retirement plan. I don't really care about that. Neither is Boeing stock, apparently. It didn't move. What's another $3.6 billion between friends? Apple after supplier tax breaks in India. Netflix, blah, 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 who cares? Nissan, 3%. Okay, that's another one. That's significant because that's 3% of 128,000 is 36,000 cars. That's why I didn't care about Subaru. This is way worse. So now we're looking at pretty big negative on the auto side. And now the auto sector, that affects a lot of things. So now that's going to be a serious effect on the S&P. All right, so you get the idea. So there's that. Then I'm thinking also, what kind of news was it? Was it shocking news? Was it immediate thing? No, it's kind of, especially since most of the news is negative in the last hour or two, most of the news is negative in auto. It's the kind of news that people are going to have a meeting about. A fund is going to sit there and they're going to call their sector guys and they're going to say, okay, we got the order reports today, lay it out for me. And they're going to go, crap. June sales were crap. That's the bottom line. And so the guys are going to say, okay, in that case, we need to lighten up on a few things. Not just autos. With autos, it's going to be tires, it's going to be parts, it's going to be a whole bunch of things that are going to go down because of the bad auto sales. So that's a pretty big market negative. And that means first of all, it means exactly what I said this morning, though. I knew that was going to happen this morning. I said so in the post, didn't I? I think I did. Sometimes I think of something and don't say it, which pisses me off, but I'm pretty sure I said this. PCE, okay, you'll see the orders throughout the day, and those are not likely to be good. I did say it. Okay. So, I knew this was going to happen. That's why first thing in the morning, I said we should short things. I'm like, I don't give a crap if they're punching the market up in the futures. It's stupid. There's no volume. It doesn't count. So we had a fantastic opportunity early this morning to short a whole bunch of good stuff. So I already knew this was going to happen. It's just confirming. So now that matters too, though, because I knew this. I knew it already. Whether or not the fund managers knew it or not is not my problem. I knew it was going to happen. So when I made the call, it was over here when everything was going up. And this confirmed what I thought, but in the meantime, it also means I don't see any reason for these markets to go higher from where they are now. They should be going down. This is what I said would happen this morning, and now the data is proving out what I expected to happen. So that's the way I read the news. So it's like at any given time I'm looking. And so in the case of this morning when I was writing the post, from everything I've been hearing from the auto companies that have been reporting, they've been saying the sales weren't good. So why would the auto report come out good today? That's what I don't understand. I don't understand why anybody would have thought this report could have been good. Why would the market go up this morning? It was stupid. Because you knew this report would be bad because the companies that reported already told you it was going to be bad. It's not magic. These things don't happen in a box. It's not freaking Schrodinger's cat where you don't know what's going to happen until you observe it. You know what's going to happen because you've already observed enough facts to make a conclusion. And based on that, you can bet the market is either right or wrong about a certain position. Yeah, I mean, I wish there was an easier answer than that, but it's like because of all that stuff. That's how we count it. And then you've got to get yourself an impression. Now, when I started investing in college, and I started before college, but I mean, when I started investing for myself, I invested for my grandfather, with my grandfather, since I was 7 years old. So when I was in college and started investing for myself, I already had 12 years of experience. So in college, I started buying tech because I was into tech, and I only played tech. Even though now my grandfather wouldn't touch tech with a 10-foot pole. My grandfather played old companies that he understood. He was a Warren Buffett kind of investor. He would play stuff he understood. He would play retail because he knew everything about retail. He understood banks. He would play banks. He would play shipping companies. He knew about trade. He was in the garment business. So he knew all about the garment industry, and that meant he knew about shipping. He knew about retailers. He knew about warehouses. That's kind of stuff he knew about. So he traded what he knew. I learned that stuff from him. My expertise, though, at 19 years old, was in tech. I knew more about tech than pretty much all the analysts on Wall Street who were bullshitting about tech on TV because they were all old men. Now, they were old men. They were 40, 50, whatever, but they were old men who were completely baffled by what was going on in tech. I understood it because for me that was life. Just like my kids now understand all the apps, and I'm like, what? I look at them like, what the frick are you doing? And they're like, bip, 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 and they can make everything work. I used to be cutting edge, state of the art, and now I feel like a real piker when I'm like listening to all this stuff. But you play what you know. So from tech, so what happened to me is from playing tech, I started playing retail because I got more and more familiar with retail. I knew about retail anyway. I worked in retail, but I used to manage a stereo store, so I knew a lot about that. And after college, I worked with Intelligent Electronics, selling computers. So I, really merged all that knowledge. Anyway, so I went from tech to retail because the retail sold the tech. Then I went to distribution. Then I got into the semiconductors because they were supplying the parts for my stuff. And then from the semiconductors and the shipping companies, the local shipping companies, I got into the overseas shipping aspects of things. And so in other words, I just kept following the transactions that I was familiar with, and my base of familiarity touched on other things that I would then explore and become an expert in the other things over the course of many, many years. So what I'm saying is when you start, pick something you really know a lot about. Pick a specialty and trade in that area, and that way when you're reading the news in that area, it's all going to make sense to you. And as you're reading the news in the area that you're specializing in, you'll see, like I'm saying, if it was tech, in my case it was tech, so what would screw me up with tech? Well, apparently, as I'm learning more and more about tech, I'm like, well, it's very easy for me to see that this chip or that computer or that computer is going to be a big seller. But then what happens? Then it goes through Christmas and my computer doesn't sell. And I'm like, what the hell happened? And I have to go back and I say, well, apparently there was a distribution problem. And then I find out there was a shipping problem. Then the retailers didn't do this and that and didn't discount it correctly, or some other retailer was selling some other hot item. So it forces me to look into something. And as I'm looking into things that affect the thing I care about, I learn about those things. And I learn more and more about how does that distribution channel work? How does the retail channel work? What's going on with these markups? That makes me then more effective at predicting. I learned that just because Hewlett-Packard puts out a laser printer that's cost-effective and so on and so forth doesn't mean the salespeople who are out there in Staples are going to be able to convey that to the customer. How are they going to convey what was then a $3,000 printer was better than the dot matrix printer, than the $1,200 dot matrix printer at the time? How were they going to make that sale, even though it was completely obvious to me? And that's what you also have to realize sometimes. You have to realize that something obvious to you is not obvious to everyone else, and that doesn't make it a good investment. Because it was completely obvious to me that Hewlett-Packard was going to kick ass with these laser printers, yet they weren't getting any traction in the first couple of years. They were too expensive. They're too this. I don't understand it. They couldn't convey. They could not explain to the customers. After a few years, though, Hewlett-Packard figured out how to sell laser printers. And that was the key. Their in-house people figured out how to convey the value, and then they were able to teach the people in the stores, and they were able to teach the people in the things. They also shoved them out cheaply to a lot of offices, and then people learned the value by having them come from Hewlett-Packard. But they realized you couldn't just expect someone to pick it up and buy it just because it was a completely superior product. That wasn't enough. Having the best product isn't always enough. But to understand that, the same way Hewlett-Packard didn't understand why they couldn't sell, because they were techie guys. They could not understand why people didn't just snap these things up for $3,000. Made no sense to them at all, and it really didn't. If you do the math, there's no way you shouldn't buy a laser printer, even when they were that much money at the time. So as you become better at something, as you become a specialist in a certain sector, you will touch on other sectors that you realize affect your sector. And the more you understand your thing, the more you'll understand the thing that affects you, and then you'll see the repercussions. And you follow the threads, and you learn more and more about stuff, and that's how you branch out your knowledge. But you've got to let it come over time. You can't just jump in and say, oh, I'm going to be an expert in this. It doesn't work that way. You've got to start with what you know. So like I said, for me, I knew generally about business from my grandfather. I went to college. I learned it. I obviously took business in college and so on and so forth. And during that time, I worked in retail myself. I was heavily into computers, loved tech, devoured the magazines on it, read every single report that came out. That was my favorite thing. So it was a no-brainer for me to sit there and start betting on. I would buy stock in Intel and Cray and Microsoft and so on and so forth, because I could see these companies were doing great stuff, even though people didn't even understand what they actually did. That's how you have to start. And if you do that, then the news will, then what I'm saying about the news will make more sense to you. At this point in my life, it's like 30 years later, I'm a generalist. So now I've branched out. I have a lot of knowledge in a lot of different places. Now I read all the news, and it all matters to me, and I think of all the different little threads like a spider. Like I think of all the ways all the threads get affected, and then I come up with a market consensus on how it works. So I'm looking at a lot of stuff, but if you want to do it for yourself, you probably should start by specializing and work from there. And what are the lines on the screen represent? Those are what they call pivot points, okay? They are standard thinkorswim representation of the support and resistance lines on the chart. Oh, look at oil popping. All right, so 48.90 was our first spot, remember? That's a weak bounce, so we'll see what happens after that. Seeing that these guys are not really going anywhere. We'll see what happens. But now see, oil popping is going to make the S&P happy, and oil popping is going to make the Dow a little bit happy. So, this is only a bounce, but I'm just saying if it really comes up, then they're going to be a lot more relieved. What was your question? I forgot now. Oh, the lines, right, yeah. So these are support and resistance. So every day, the support and resistance lines are drawn. These are called pivot points. If you right-click on the screen, and you go to Studies, and it says Add a Study, and it's a trend study, and under P, it says Pivot Points. That's the study. And so if you do that, it adds these lines to your charts, and that tells you where the computer has calculated the supports and resistance line are. So this is first resistance line, resistance 1, resistance 2, support 1, support 2, and the midway line. And so that is theoretically the likely range, the most likely statistically range for the day. It's highly unlikely that things break out of their pivot points, which means it only happens all the time. As you can see with gasoline, they break well below their support. Oil didn't break that far below its support, but gasoline tore through its support. It missed by a hole. Like that would be support 3. Not that there is such a thing, but that's support 3, and you're almost down to support 4 at that point. So that's what they call 2 standard deviations below the anticipated range. So it's highly unusual move for gasoline, and that range was not anticipated. So that just gives you, but it gives you an idea of the range that's expected for the day. And they draw these right away at the beginning of the day, so you can see exactly what they think is going to happen during the day. So that's the most likely range. So when something is at the top of a range or the bottom of the range, you know it's a good time to go long or short. And you have a high likelihood of success. So ideally, though, you don't just do it because it's at the bottom of the range, but you go to the bottom of the range, you find out why something went down that much, and then you find out if maybe that should be it for the day. Now, in oil's case, we thought it was going to bounce off 48.50. That's why I got out of my trade at 48.50, which was a nice bottom call. Could have played it long. because we knew it was going to be a 40-cent down. And 40 cents happens to be the 2.5% line. So we have plenty of reasons to know that that was going to be the bounce. Now, we also know, though, that if oil does end up settling down at the 2.5% line, that means most likely tomorrow it's going to go down another 1.25%. All right? And so what's 1.25% from 48.50? Let's see what the next line is going to be. Where's the thing? Calculator. All right, so we take 48, and we know 48.50 is a serious support line anyway. 48.50 times 1.25%, 0.9875, right? Is 1.25% less? Yes. So 47.89. So 47.90 is your next support, and that happens to be this green line over here. See? That kind of confirms what you think. So the next support is going to be this 47.90 line. If we hover here, 48.90, which is what I said when I got out before, I said we're going to go to 48.90 on a week bounce. I didn't want to stay in for the week bounce. Obviously, why should I? I had 5 contracts. I would have lost $2,000 just watching the bounce. So why should I stay in my 5 contracts if I have a very strong belief it's going to bounce? Did I want to go long? No, because I'm not long on oil. I didn't want to go long for no reason. I didn't feel like flipping long for the bounce. But here we are at 48.90. This is a week bounce. If it fails to get above the week bounce line, and the week bounce line happens to be the 2.5% line, that means it's very likely, that means you can ignore this spike, and all we're doing is settling at the 2.5% line. That means it's probably consolidating for a move down. And that move down goes to 47.89. Another $1.10 lower, or another $1 lower anyway, but another $1 lower. And after that would be 46.50, and 46.50 would basically complete a 10% drop. So we will see what happens, but I believe that's what is going to happen, because I didn't want to get out here. But I said at the time, I was like, I'm so glad I'm up. I'm like, I'll take the frickin' money and be done. And it's tempting to play here, but I'm still going to wait for tomorrow. But I do think we're going to continue down to this 47.89 line. So we'll see if that pans out. And of course, that's pending news. Given the current amount of news, that's where we should be. Something changes, that could change the play. Where are we? Green, red, white. Green, red, red indicator on Thinkorswim. That's the setting you turned on. Mine doesn't show that. Yeah. Okay. So hopefully you found it. And if not, they have really good technical support. Don't be shy about calling Thinkorswim technical support. Those guys are the best. YES and not YM. If YM is down 0.36 and ES is down. I don't care what they're down. What I care about is where they are down as far as proportionally. Because, in other words, ES didn't have a big run up like the Dow did. The Dow had a huge run up over a few days. The S&P is essentially not barely over flat over the same period. So the Dow is heavily extended. The S&P is not heavily extended. Or did I say that backwards? YES. I did say that backwards. So, I'm sorry. So the Dow, why did I say yes? Oh, because this was a better line. I was trying to show you the line. That's why. And it's also not in a vacuum, because a lot of the Dow gains from Boeing, and it was well-deserved. Don't forget, the main reason the Dow flew up was Boeing. And there's no reason why should Boeing go back down? Boeing had fantastic earnings. They deserved the gain they had, and that made the Dow gain. So there's no, you can't punish the Dow because Boeing's a good company. Just like tomorrow, if Apple gains 20 points tomorrow, the Dow's going to go up 160 points. And just because the Dow goes up 160 points and you think that's bullshit, won't change the fact that the Dow went up 160 points. And if it went up because of Apple, it's not going to go back down because of Apple, because Apple would have deserved it. All right, so you got to think about why something's up. But the S&P, the reason was because it's a good line. The S&P is a solid index. In other words, I can easily get in and out with a very small loss on the S&P. The Dow tends to move quicker and is more dangerous to play. The S&P is very easy to play with one contract, makes very small moves, and is very respectful of its resistance points. The Dow is not respectful of its resistance points the way the S&P is. And you can see that because look at the Dow violating this line and look at the S&P violating its line. Okay? It's the same thing. Now here the S&P went up higher, but it didn't go, it never made, but it went higher, but it was less than the Dow because the Dow went flying up to this resistance point. The S&P only went half as far as the Dow. So the S&P is more subtle than the Dow, and is much more likely to hold a line that you get into. There are times I'll take the Dow, especially, let's say this move had been because of Exxon and Chevron, okay? And that was because oil went up. So oil went up, and then Exxon and Chevron went up and bumped up the Dow. That's not what happened. This was both. But if Exxon and Chevron made this move happen, and I thought oil was bullshit, then wild forces couldn't stop me from shorting the Dow. Because then I would say, but the Exxon and Chevron trade is going to unwind, and that's going to yank the Dow right back since all of the gains came from those two companies. But in order for me to short the Dow right now as a preference, I would have to believe that the Boeing gains were bullshit. And they weren't bullshit. They were perfectly legitimate. Oh, man, stopped on a dime at that 90. That's a really good sign for the short. All right. No, YM is not the laggard. YM's ahead. But again, you got to ignore YM. You often have to ignore YM. If you want to know what the Dow is doing, you've got to look at the chart and say, who's influenced me today? So you go to the Dow on the after, the easiest way. I don't know an easy way to do it. And you go to components, and then it's going to show you all the different companies. And since the Dow is price-weighted, not index-weighted, all that matters is who moved the most money. It doesn't matter what percent of the money. It doesn't matter if somebody moves 20% and someone moves 1%. If the 1% is a bigger dollar number, that matters more. All that matters is the dollar number people move. So small moves, small moves, small moves, small moves. Small moves are like 50 cents or more. Here, IBM up 50, UNH up. So I want to think if it's deserved or not. IBM always deserves more, that's fine. UNH up, don't know if they deserve it or not. Travelers up, don't know if they deserve it. Walt Disney up a little bit. But all these guys are up about the same. Boeing took a hit. They pulled back off their run. Caterpillar down 1%. They had a nice run too. 3M is up 1%, don't know why. Goldman Sachs up 2%, even though they had bad numbers. I don't know why they got that. Not 1%, it's like $2. So there's a lot of small contributions to the Dow that added up, but nobody is there's no one single significant thing that jammed up the Dow. Now we talk about Chevron. Chevron's up $1, and Exxon. You know they're in the Dow. Yeah. And then Exxon's flat. So the net contribution from oil is 8 Dow points, or maybe 10 Dow points from Chevron and Exxon. So 10 of the Dow points is Chevron and Exxon. That means the oil falling back down isn't going to affect it much. Generally, the big gainers, the guys who gained $1, these are J.P. Morgan, Goldman Sachs, Chevron. All right, so Goldman Sachs and J.P. Morgan add up to 2.5 points, 3.5 points. So let's call that like 30 Dow points, or whatever it is. But so let's say half. So a good portion of Dow's gains is from J.P. Morgan and Goldman Sachs, and travel is also another technically kind of a financial. So now I got a premise. Now I think, well, including travelers, we got like 40 points of the Dow is, and it's almost half the Dow's gains are from financial. So if I think the Dow is going to go back down, I have to think the financials are going to reverse their gains for the day for some reason. I don't have any reason to think that. There's nothing I read in the news that indicates that. So if I don't think the financials are going to reverse, why bet against the Dow? It's pretty simple, right? I look at the Dow, I see where did the gains of the Dow come from, And once I know where the gains of the Dow come from, I go back and look at the news and I say, well, what would affect the gains or the losses of the Dow that I should change it? And if I don't see anything, then I don't have a premise for shorting the Dow, so I move on. I think a lot of you guys, I think the problem is you want to have a premise, you want a reason to do something, so you start off saying, I want to short the Dow, and you look, whereas I go the other way. I'm reading the news, and while reading the news, it might occur to me that something might be a good trade, and then I kind of look to see what sector is it in, what index is it in, what ETF is it in. I start thinking of different ways that trade might be a good way, might make for a good trade today. And again, 99% of the time, I look at something, I end up rejecting it. I look at so much stuff all the time that I just say no trade for. Says, how many trades can you even have? I mean, honestly, we do this 200 days a year, 200 whatever days it is that we're on, and our portfolio has our 4 portfolios have 100 positions total. So if I picked a trade every day, we would have 200 in 2 years. We'd have 400 positions. Can't do that. You got to take good ones, and you got to have the patience to sit back and just do. And I have a lot. You shouldn't have 100 trades, obviously. But I'm saying, once a week, once a month, you should find a good trade, not once a day, unless you're a day trader. But then that's a whole different ballgame. But I'm looking for things I really like, and unless I really, really like them and think very strongly about them, I just move on to something else. It's not important. There will be a trade. Let it come to you. Don't go looking for a trade. Don't force it. When it's obvious, you'll know it. You're only going to know, and you're only going to know it if you step back and remove yourself from this thing. It's like another big problem people have is they say, okay, Friday at lunch, I'm going to sit down and trade. And so Friday at lunch, they sit down and they force a trade because that's their time to trade. I'm going to trade now. Doesn't matter whether it's a good situation, a bad situation. Doesn't mean if there's anything obvious going on or not. They feel like they have to trade because that's their time to trade. It's a terrible way to trade. It really is. The way I trade, especially before I did this, where I'm sitting here every day. So now I'm like a market addict. I sit there all the time doing it, which I love, but that's beside the point. It's funny. It's like my wife's like, I go on vacation, and I'm always working anyways. And I'm like, so what? If I wasn't doing this, I would still be reading the same thing. The only difference is I'm conveying what I'm reading to other people. That's the only difference. Other than that, it's not like I wouldn't be reading all this crap if I was on vacation. This is what I love. If I go on vacation, I want to sit down on a deck chair on a ship and read about the markets, and I want to check my portfolio, and I want to make trades. That's what I like doing. I prefer doing it on a beach, but other than that, it's really no different. I get bored to tears. If I take 2 actual days off, I really start getting like antsy. But anyway, what was I going to say? Oh yeah, so. But still, for me, much as I love trading and all that, I trade I will read 5 market magazines, and I will sit there and look at the dozen websites, and maybe I'll get off the couch one time to make a trade. I'll get up and go, because maybe one thing is going to inspire me out of a whole day's reading to go, there's what I want to go look at and see what that company's like and make a trade on. And even then, even if I like the company, I might look at it and I say, it's too high in the channel, it's too this, it's too that. In fact, today in chat, what did we just talk about today? There was a really good one, but it wasn't cheap. Wasn't Teva. Dollars, Lumber Liquidators, ALB, there you go. So Jean-Luc said ALB was nice, and I looked at them, they're a lithium miner. And that's a great business. I love it. I like the concept and everything else. And I say, look, I love it. I think this is great. It's a fantastic idea. I like everything about this company, but they're not cheap. So I looked, and I said, the only trade I see out of that I like is because I would buy them if they got cheaper and the 95 puts at 650. So that's a pretty good price. I think that's very fair because if you sell these puts for $650, you're netting in for $98.50. I'm sorry, not $98.50, $88.50. You're netting in for $88.50. So it's as if you bought it before it popped. So to me, that's a great way to start the trade. Because if you sell like 5 of those for $3,250, $32.50. You sell 5 of those for $32.50. So you're putting $32.50 in your pocket, and you're saying if it ever gets back to if it comes back down to $88.50, I'll buy it. Then I'll get in, and then I'll start working the trade. Otherwise, you keep the $32.50. So that's the way I like to make the trade. So that's almost. I kind of would like that in the long-term portfolio, but I still am greedy, and I still would like to see it come back down to 105, so I can get $8 instead of $6.50. Then I'd really be happy about the trade. I'd love to see it retest that 105 one. So I want to put it on the watch list. I want to keep an eye on it. And if it has a nice dip, I want to pick it up because it's a totally fantastic idea. But again, that's the kind of thing that would get me off the couch. I read that, or I talk to somebody about it. I talked to John Luke about it today, and I see this stock, and I looked it up, and I did a little research before I talked to him about it. And I said, oh, that's a great company. I like what they're doing. I like the diversity. I like where they are. I like their spot. I like the business they're in. I like the sector. Everything's good about this company except the price. So I don't make the trade. In the end, I still won't make the trade. Great idea, though. What we did do is Teva. I added that to the short-term the options opportunity portfolio today. And Teva, it's in the long-term portfolio already. It's still cheap, and I wanted to add it. So we talked about Teva, and we added this trade. And I like this trade because here we're selling 5 of the 2019 $30 puts for $420. So that's $2,100 you collect. And same concept. So if they go below 30, you're obligated to buy it for $30, but you collected $420, so you're netting in for $25.80. Right? But we're also then turning around and spending some money. We're going to buy 10 of the 2019 3250 calls right here, and we're going to sell the 40 calls way up here. Don't forget, it's 2019. That's 18 months from now. So we're hoping in 18 months it comes back to 40. Now, the net of that spread is $2,300. So we're buying the spread for $2,300. We're selling this spread for $2,100. We're selling these puts for $2,100. So our net cost is $200 on the spread. If we hit 40, you're going to make $7,500 back on $200. You're going to make a $7,300 profit on $200. But don't forget, though, you are obligated to buy $15,000 worth of Teva. So, yeah, it's only $200 in cash, but you have this obligation hanging over your head to buy $15,000 worth of Teva at $30 a share. You know, on the whole, it doesn't use a lot of margin. In fact, I'll show you on Thinkorswim. It's not very. I'll see it came down nicely already. That's definitely going to collapse. TEVA. All right, so we're talking about the 2019 30s, and they're still $4. And sell them, and we're going to sell 5 and $4 and confirm it. And look at that margin. So your buying power is only hit by $1,300. So very, very, very margin efficient. You're collecting, in this case, you're collecting $2,000 because it went down a bit in price. You're collecting $2,000, and you're only putting aside $1,300 in margin to do it. That's what we call margin efficient. You're collecting more money than you're using in margin. And then we take that money and we put it towards the trade. But on the whole, that's a nice low margin trade, no problem. You do have the obligation. It's a real obligation, though. If Teva goes down to 15, you still have to give them $30,000. Not 30, 15,000. You still have to, if it goes down to $15, you'd still have to pay for 500. You'd still have to pay 30. It doesn't matter. And you'd be down to 750. You'd be down to $7,500 if Teva goes to 15. Of course, if I thought that was going to happen, I wouldn't be doing the trade. But this is great way to get in. It's a nice cheap entry, and it's a little speculative because we're out of the money. We're buying the 3250s, and they're not even at 3250. But that's because I think Teva is very, very underpriced. And I talked about that here. I said they have 1 billion shares, so 32 is 32 billion, and they made $3 billion in 2014. They made $1.5 billion in 2015. They've been doing acquisitions and stuff, so they've been building the company. 330M last year. Going forward, though, they made $645 million in this quarter that just went by. Their next earnings are on the 3rd, Wednesday. But they announced in Q1 they made $645 million. That's more money they made all of last year, double, in one quarter. If they do that again this quarter, that'll be 12.5. They'll be on path to make $2.5 billion this year on a $32 billion valuation. That's ridiculous. They're so massively underpriced. And that's why I think that 40 is a very obtainable target. All right, now in the long-term portfolio, we already have an aggressive position on these guys in long-term portfolio. We got aggressive around here in June. When it got back over the hump at 30, that's when I started to get more aggressive on the position. It really isn't, it's only $2 higher now. So I'm sorry I didn't take the options opportunity to play back here, but you know, whatever. So it's still a good trade and still worth picking up at this point. And that's how we come up with our trades, though. But like I said, we don't force them. One of the reasons I wanted to have this chat room in the first place is because if you're not online, if you're not talking to people, if you're just sitting there staring at the computer all day, you really have a tendency to overtrade. You can't just sit and stare at a monitor all day long. It's not good for you. It's just you go crazy for one thing. You tend to overtrade. You tend to it's good to have people to talk to. It's good to have something else going on. People complain about talking about politics. I'm like, well, you talk about politics. You can't just sit there and worry about the market all day long. That doesn't make you a better trader. It makes you a crazy trader. You start thinking everything that happens is important when it's not. In the grand scheme of things, it's not that big a deal, most of what happens in the market. All right, so where are we? What time is it? I had to absolutely be done at 2 because I have a conference call. Okay. What news feed do you like best to follow? Well, like I said, during the day I'll tend to look at the Seeking Alpha one because it's already well curated. So I like that. Otherwise, I look at my own Twitter account because I don't follow people in Twitter. I don't follow Donald Trump or people like that. There are people, but I follow people who I respect and who post market things. Like if I tweet, I'll tweet 1 or 2 things a day, and I don't tweet cat pictures and crap like that. I tweet things that I think people who follow me on Twitter want to read. And I have a lot of Twitter followers, probably because I don't waste their time. People people don't tend to kick me off once they add me. They'll add me and they'll kick me off, and they don't kick me off because I don't bother them. I put out my morning post on Twitter, and once in a while I'll put out some news or information that's usually relevant because I think it's really important. So my rule for following people is I follow people like me. I follow people who post good, important market information, guys who are really smart, and guys who are on the ball. And so my Twitter feed to me is the best source of information in the world. I follow maybe 200 people. I don't even know if I follow 200 people. Yeah, 281. I follow 281 people. And if anybody wastes my time twice, one time you can waste my time, talk about, oh, my girl went to camp today or whatever. If I hear that twice, I'm done. I'm out. I drop somebody. It's like I have zero time for that. I only want facts in my Twitter feed. I want to know what happened in the market. So this way, I have 281 people I respect who are going to put up information that I care about in the market. And that's what you have to do. You have to build yourself a network of people who you actually want to follow and who give you good information. And again, it goes back to in your sector, in the things that you care about, Learn who talks about it and who has a good point of view and who makes intelligent comments and doesn't tweet out crap. But that's why, to me, I never understand why Twitter doesn't do well as a start, because I don't think most people use it correctly. I think people generally use Twitter as like this incredible time waster of triviality. But if you use it the way I'm using it, it's an unbelievably effective news source. Because you can customize anything you want to know about. You can customize the feed and get this incredible instant information on anything going on in the world. It comes to you so fast that, and it's curated. It's curated by people I care about. Like Barry Ritholtz is telling me what's important today. If Barry's out and about and he sees something important, he's going to tweet it out to me. And that's fantastic because he'll see it before I do. He might be standing on the floor of the NASDAQ when something happens. You know, that's the kind of guy I want to follow on Twitter, right? You know, and I'm at the NASDAQ, so I'm being interviewed at the NASDAQ, and I'll tweet out like, oh, talking about this stock on the NASDAQ today, and then people might go, maybe I should buy that, you know, because Bill's talking about it. That's the kind of people you want to follow on Twitter, people who actually move the markets and people whose opinions matter. Not, you know, just dump your family, dump everybody else. Tell them to go to Facebook. Facebook's great for bullshit family stuff. Twitter is great for news. And you got to build it yourself. You got to build a good Twitter feed with good news. Since option lose values over time, you usually need to let your spreads expire in the money to make money. Yes, if you pick up a spread, it's a targeted play. So we don't generally tend to want to mess with a spread. We do deconstruct them sometimes. Like sometimes, let's say we bought the Exxon 80-90 bull call spread, right? And let's say Exxon pops up to 85 because of some news. And then let's say we don't think that news was worth 85. So we might sell our 80 calls for, let's say they go to $7. We might sell our 80 calls for $7 since most we can make it anyway. But we'll leave the short calls because we don't think they're actually going to get to 90. And then we wait, and then if those things expire worthless, we do well. So sometimes we'll deconstruct the spread to maximize our gains. But generally the plan is to set and forget. We put up a spread it's because I feel very strongly that we're going to be at a target price at a certain time. All right? And don't forget, though, we use that losing value to our advantage because we buy something with low premium. Generally, we like to buy calls that are in the money. And we sell calls that are out of the money so that the person we're selling the calls to pays all the premium on the spread. We have no premium. And I'll show you what I mean by that. Again, we'll go back to Exxon, just since I mentioned it. XOM. So they're at 80. That's a bad example. Well, 80 is a bad example, but I'll show you. If I want to take a spread on Exxon, and I think strongly they're going to be up at 85, right? I might buy the 75 calls for $8. So at 75 to 8, I'm paying 83, right? I'm net 83. So if I buy the 75 calls for $8, I can sell the 85 calls for $3.50. And now my net has dropped from, 8? My net's dropped from 8 to $4.50. So now I paid $79.50 for the 70-80 spread. So I paid net $4.50. So I'm actually in the money. I paid no premium. Not only did I pay no premium, I got a discount. I only paid $4.50 for being $5 in the money. And all Exxon has to do is go over 85, and I double my $4.50. I more than double it. I get $10 back. So that's how we like to construct the spread. We like to be in the money and sell some other sucker the premium out of the money. So he's paying the premium to us. So we're being the landlord. We're renting out our position for a high price. Okay, so again, I'm maximizing my gains. I can only make $5.50 on the play, but you know what? $5.50 is pretty good. Making 100% is always good. It's 125%. That's good. So Joe says he's in for the futures weekend. Oh, we are doing. Of course, we're going to in November when I get back from my next trip, which is in 2 weeks. We're going to start planning our Vegas trip, which is going to be a seminar weekend. Not all futures, but we do a lot. But we actually do a lot of futures trading on Monday. So the way our seminars work in Las Vegas is we get to Vegas. It's President's Day, not President's Day. Shit, what do they call that thing? Veterans Day. Veterans Day in November. So it's usually like the second weekend of November. Because Veterans Day is a kind of holiday. It's the kind of day where a lot of people, if they work, they can take off from work. It's like the kind of thing where you can take it, you can kind of take that day off. It's usually slow, even if you have a real job. Other people take off and it's slow. It's a long weekend people take. But anyway, so it just works out. Because the idea is to pick a weekend when the markets are open, but some people have, but people are able to take a vacation. So we do it Veterans Day pretty much every time. Veterans Day is the second Monday in November usually. I'm not even sure which one it is this year. And the way it works is we arrive at Vegas on Saturday. Saturday night we usually have a kick-ass dinner and we have a poker tournament. That's our general plan. Sunday is the first day of the seminar. On Sunday I usually do the overview of the markets, like the global overview, and talk about the markets and talk about general stuff, and we'll go over like a bunch of stocks that we like based on the market situation at the time. We usually figure out our top trade of the year for next year by then. And of course, lots of Q&A, like we talk. It's usually from 10 o'clock till 4 or 5 o'clock. We'll do that. Then we have dinner on Sunday night. So we have a second dinner on Sunday night. Then Monday we're up at 6 because 6 for Vegas is when the markets open over here. We have a 6 o'clock start on Monday, and we trade the market from 6 to 3. So Monday, all day long, trading live. That's what we're doing. All day long, we're reading the news. We're trading stocks. That's what we're doing. Exactly what we do during chat, except live. And people talk, but then I can get into like really good explanations, and we can talk about why we like something, why we don't like something. We can go over live research. It's very cool. People who go love it. So that's what we're going to be doing in Vegas in November, and I'm going to be away next week. I'll still be working, though. I'm going to be on a boat. Going to be away next week, and we will, wait, what's today? Oh, yeah, tomorrow. Tomorrow I leave for Florida, and then next week I'll be on a boat. Right, that's how it works. But it's a working trip. I'm not really taking any time off, except for maybe next Wednesday. Because next Wednesday we'll be in St. Martin, which I happen to love St. Martin. So, what was I going to say? Oh, yeah. So when I come back from that, we'll start having a more serious conversation about the Vegas trip. But usually Caesar's Palace. I stay at the Nobu Hotel, which I think is fantastic. And it really wasn't that expensive, so everybody should really stay there. We'll get that trip started to get the ball rolling. So it won't be all futures, but you know what? While we're doing it, maybe we should talk about doing that also as like another side thing. Because I wouldn't mind doing it. And futures we can trade. Again, you can't trade on a weekend. We have to find a time when the markets are going to be open, but people have time to sit there all day and do it. But I think a day trading futures all day long would be probably an interesting way to spend a day one time. Since options lose value with time, we just talked about that. What's your view on oil over the next month? Will you be looking? Yeah. Well, see, I'll break above 50. Well, I'm looking to short it right now. I'm sorry I didn't short it at 90. At 48.90. Oh, here it is again. Okay, so now I won't be sorry. Let's let the API report come out and see what happens. But I think there's going to be a lot of pressure on oil. Let me see if I can find this 9 minutes. Yeah, I look at my other computer down what's it called. Where is it? Here it is. Futures.tradingcharts.com. Let's try that. Futures. Oh, okay, great. Futures.tradingcharts.com. Commodity quotes. Doesn't look right. Futures.tradingcharts.com. Market quotes. Market quotes. Commodity quotes. Market quote, isn't it? All right, let's try writing it. Market quotes. It doesn't look right. Oh. Ew, I don't like what they've done here. It's ugly and different than the way I look at it. All right, still doesn't matter. Crude, NYMEX crude oil, quote, chart history. I think I want to quote. Yeah, there it is. Okay, good. Oh, see, this is what I'm used to. This is my normal chart. That's how I'm used to using it. So I just hit the crude oil NYMEX, make sure we got the right one. Okay, great. So this is what they call the strip. These are all the contracts. And as you can see these things, that means if there's dashes like that, that means they're not actively traded. That means there's very little trading activity going on. Last trade here was July 31st, July 31st. You know, I guess a lot of trading was done July 31st, but they don't trade every day. Okay, so these times and these prices, if they're not being traded actively, they can be weird prices. So you only pay attention to ones that are actually trading. Whoops, that. All right, I'm gonna track all guys. This computer hasn't now. All right, here's the thing. All these orders are fake. That's number one thing to know. Out of all these orders traded, only 15 million barrels will actually get delivered. 15 million is 15,000 contracts. So this is 592,000 contracts. That means of the 592, 580,000 of these contracts, 575, are fake orders that will be either canceled or rolled by the end of the month, or by the 22nd, which is the day the contract expires. So the bulk of these contracts have to be distributed across other months. Now, the problem is that December is already jammed up with 337,000 contracts. So for them to distribute these across these 3 months, as you can see, the front 3 months now have 6, 7, 8, 9, so 9.9 and a bit 100 million contracts, right? Or 900,000. I know it's confusing when I talk about it. In my mind, it's all barrels. So there's 1,000 barrels per contract. So I always talk about millions, even though it's 100,000. So there's 900 million barrels of oil represented here. But there's already 337 here. So when these go, if they try to roll all these into these months, there will be 900 plus 3 is 1.2 billion barrels will be jammed up into the front 3 months when this month disappears. 1.2 billion barrels, 30% more oil, that's fake orders, will be in the first 3 months than they were this month. Now, that will get better the next time because the next time they have less, so it'll drop. But the bottom line is there's a lot of damage. There's going to be a tremendous amount of pressure. It's going to be very expensive to roll these contracts. It's going to be there's going to be a real panic in the people who have all these fake contracts who are going to try to wriggle out of their position. So that's the real catalyst to driving prices down. If these guys cannot sustain 600,000 open contracts in the front month, and they certainly can't carry it over to here and have 900,000 open contracts in December by the time they get to December. That's just untenable. Usually if there's over 650,000 contracts in a month, they're in trouble. And here you're talking about possibly having 900,000 open contracts in a month. It's a ridiculous amount. It can't happen. So at some point, a lot of these contracts need to get dumped. And so there will be a very sharp, nasty sell-off at some point. Now, we already had a sharp, nasty sell-off today, but this isn't, obviously, there's still so many open contracts that's not going to put a dent in their problem. So what we do is we keep an eye on that. We keep an eye on how many trading days are left till the 22nd. So right now there are 5, 10, 15 basically trading days until the 22nd. So they have 15 days to get rid of 600,000 contracts, so that's 40,000 a day. That's a lot. Okay, that's a lot of contracts per day average to have to move. That's the problem. They're all fake. None of these orders are actually going to get delivered. They're all pretend orders that they say they want to buy something, which we do all the time. We do with options. Not illegal, but it's wrong. It doesn't give you an accurate picture of the value of this, because nobody intends to get it. It's all a big joke. And they do it just to jack up the price of oil. So we'll see what happens. So We'll keep an eye on this. You keep an eye on how wide the spreads are. Look how narrow the spreads are, actually. Oil, 50.17 now, and oil is 50.96 in 2019. So 2 years from now, you can buy oil for about the same price that you can buy it for now. So if you're going to be an oil bull, why don't you just buy these contracts? Give you 2 years of possible upside. Why doesn't these contracts have 1 million barrels? Why are there 500,000 of these? Because you can get for 2 years you can lock in a price. You know why? Because all these are freaking fake. These are probably real. 26,000 might be real, but all these contracts are fake. That's why this whole thing is a goddamn joke. So if somebody really wanted oil, they would lock in 50.96 and not be messing around with these. What possible? If you're in business and you want to lock in the price of oil, why would you buy in November to lock in that price when you can lock in 2 years from now? And guarantee that for the next 2 years you don't pay a penny more for oil than $51. Why would you even bother messing around with it? Because if these go up, that'll go up. You can't lose. The only way you lose, obviously, is if it goes down. You'll still pay 51. You pay the same because you're buying along. But since you net get to buy oil for a cheaper price, you still don't lose because your oil still is cheap. You just buy it from someone else, and you've got your long contracts. That's what hedging is supposed to be about. That's what it's for. You know, if Boeing wants to sell, if United Airlines wants to sell you a ticket to fly to Europe on December of 2019, they want to know how much the fuel is going to cost them. So to some extent, they want to hedge the price of fuel so that they know that it won't be crazily over. If they think the oil is going to be, if they're selling you first class tickets to Europe in 2019, and they're assuming oil is going to be $51 in 2019. But when it actually gets to 2019, it turns out oil is $140 a barrel. Then they're screwed. They're finding that plane at a loss. Now, for an airline, the closer it comes to the time, the more they want to lock in their prices, right? So, but meanwhile, if there's a good price, if they have their own analysts, and their analysts say, I don't think oil is going to be much cheaper than that, this is a good time to lock in prices, that you should want to lock it in. So to some extent, that's what you have. You have some commercial bidding that's legitimate, but it's nothing even close to the size of speculation. If you follow this thing every day, you'll see its number go down and down and down and down until on the last day it's going to be like 15,000 barrels, 15,000 contracts for 15 million barrels. Everything else is just a joke. And that's why we make so much money on it, because we know it's a scam, and we understand the scam, and we know how to play the scam. And that's what it's all about. And why does it always pay off? Because the people who lose their money to us over and over and over again, they are participating in a scam because their job is to jack up the price of oil nationally. And so the little bit of money that they lose to us is nothing in comparison to how much they make people pay at the pump for 20 million barrels worth of oil a day that this country uses. If they can get that price up $1 on 20 million barrels a day, at 40 barrels, that's 800 million gallons of gas a day. If they can get another $1 out of each barrel on 800 million barrels a day that are used in this country, 800 million gallons, not going to be $1. Let's say 800 million gallons, and let's say they get 10 cents. That's $80 million a day. 10 cents. $80 million a day they make. So, yeah, they lose $50,000 to us. It's not a big deal. That's not killing them. So they're not going to stop their con job just because we know how it works and we skim some money off the top. And that's why I can point it out. I can tell people about it. We can play it. We can make money. It doesn't matter. They're still going to do it because that's not what they're in it for. They're not in it to make money at the NYMEX. They're in it to make money so that Exxon can sell you gas for $2.15 a gallon instead of $2.05 a gallon. That's all. That's worth $80 million a day to Exxon. This is just the cost of doing business. All this fake bullshit that they do is the cost of doing business. What time is it? Oh, no, I got to go. Shit. I can't miss this call. All right, very quickly then. Let's finish up. So oil, I think, is going to go down. I think there's that pressure. Natural gas, I love natural gas. I like because we keep exporting more and more of it, and there's going to be a hurricane, and that's going to disrupt the supply. When you trade futures, do you ever watch stochastics or make it? I do, but I'm not a big guy on charts. I think a lot of technical stuff, take it with a grain of salt. I do watch them though, and when it rolls over, I do take that seriously. Would I give you some hedging advice? Oh, I was supposed to do hedging advice. I'm really sorry. I did not do hedging advice. I promise in tomorrow's post I will put up hedging advice. I'm sorry. I have to go. I have this call I have to get on. It is 3, right? I mean 2. 2 is when I have to get on. Are you still using Trade Exchange? Actually, they're revamping it, so I haven't done anything lately, but I'm still using it. I mean, we're one of the owners of the company. But I haven't really put any trades up lately, which I should. I got to talk to Mike about that. So, yes, thanks for reminding me. All right, guys, thanks everybody for coming. We'll do this again. No, we won't do it next week. Next week I'm on a boat. I'm not going to do it from the boat because it was terrible when I did it from Europe. So nothing next week, and then we'll do it the week after that. I'll see you guys when I get back, and we'll talk about going to Vegas, all right? Have a good day.